Peter Lynch's investing tip number 1. Invest in what you know. Peter Lynch's advice to invest in what you know is one of his most famous and enduring investment principles. At its core, this approach emphasizes the importance of familiarity, understanding, and personal expertise when selecting investments. Here's an expanded view of why this philosophy is so powerful and how it can be applied. 1. Leveraging personal insight. Lynch encourages investors to focus on companies and industries they understand deeply, whether through personal experience, hobbies, or professional involvement. When you invest in something you know, you have an advantage because you're better equipped to spot opportunities and evaluate risks. For example, if you work in the tech industry, you might have insight into up-and-coming companies, trends, or technologies before the general public does. This familiarity allows you to grasp the potential of a company and recognize when it's undervalued. 2. Simplifies the decision-making process. One of the biggest challenges for investors is choosing which stocks to buy. Lynch's philosophy narrows the field by focusing on what you already know. This makes it easier to identify companies worth investing in, as you can evaluate the business based on personal knowledge rather than relying solely on complex financial analysis. It also helps you avoid investments in industries or companies you don't understand, reducing the risk of making uninformed decisions. 3. Improves investment confidence. Investing in companies you're familiar with boosts your confidence because you're not solely relying on external research or the advice of others. You can make more informed judgments about the company's products, services, and competitive advantages. For example, if you're a frequent shopper at a certain retail chain, you might notice improvements in the customer experience, store layout, or product offerings that suggest the company is on a positive growth trajectory. Insights that outsiders might miss. 4. Recognizing trends early. Investing in industries or products you know gives you a front-row seat to recognize trends before they become mainstream. As a consumer or industry insider, you may be quicker to see which products are gaining traction, which technologies are becoming obsolete, or which companies are expanding into new markets. Lynch himself often talked about how individual investors can spot winning companies simply by paying attention to what's popular or improving in their daily lives. 5. Avoiding complex industries. Invest in what you know also serves as a warning to avoid investing in overly complex industries or businesses that you don't understand. This includes industries like biotech, where specialized knowledge is often required to grasp the nuances of drug development, regulatory hurdles, and scientific research. By sticking to what you know, you reduce the risk of misinterpreting critical information or overestimating a company's growth prospects. 6. Long-term benefits. When you understand a business, you're more likely to stay committed for the long term, even during periods of volatility. Knowing a company inside and out gives you the conviction to hold through market dips, knowing that the fundamentals remain strong. For instance, if you've done your homework and believe in a company's future growth potential, you're less likely to panic sell when the stock price drops temporarily due to external market conditions. 7. Avoiding overhyped investments. In the age of social media and financial influencers, it's easy to get swept up in the latest investment fads or hot stocks. However, if you don't truly understand what you're buying, you're taking unnecessary risks. Lynch advises sticking with businesses that make sense to you and avoiding those you don't fully grasp. Many investors have lost money by jumping into speculative investments without fully understanding the underlying business model. Example: Apple, Starbucks, and Lululemon. Investors who followed Lynch's advice of investing in what you know might have spotted early investment opportunities in companies like Apple, Starbucks, or Lululemon. If you're a frequent user of Apple products, an avid Starbucks customer, or a fan of Lululemon's athletic wear, you would have first-hand knowledge of their popularity, customer loyalty, and product quality. This first-hand experience could have led you to invest before these companies became household names. Summary: Peter Lynch's Invest in What You Know principle puts the power of investing into the hands of everyday people, encouraging them to use their personal knowledge as a tool for successful investing. It simplifies the decision-making process, builds confidence, and helps investors avoid the temptation of speculating on things they don't fully understand. By leveraging this approach, investors can make smarter, more informed decisions that align with their expertise, leading to better long-term results. Click the link below for more investing tips. If you enjoyed this video, please like, comment, share and subscribe for more famous investors videos.